I'm still reasonably bearish medium term on gold. I think that there's going to be short-term trading opportunities as it goes through the range.
Sprott Asset Management and a fund managed directly by Rick Rule have recently come into this tiny zinc company to become their largest shareholder. Since their recent drill results, Sprott has joined other large institutions like Euro Pacific Gold, Resource Capital Funds, and the Commodity Discovery Fund. To learn more about this incredible opportunity in the resource sector, visit crushthestreet.com/zinc.
And welcome into crushthestreet.com. Lots to talk about today. We are dealing with a lot of changes, a lot of moving parts with the global macroeconomics. And I have on the line Callum Thomas, head of research for founder of Top Down Charts. He's got a passion for global macro investing and has developed a strong research and analytical expertise across economies and asset classes. And he's out of New Zealand right now. It's 6 a.m. His time. I appreciate him getting up this early and recording this call with me. He's with topdowncharts.com. Callum, thanks for coming on the line with me today.
Thanks, Ken. Definitely glad to be here and happy to talk through some of my big ideas and give you the view from the top down.
Well, I'm looking forward to getting into it with you. I want to talk about gold and the markets. I read an article this morning that was titled "Stressed: Australians Struggle with Record Debts as Housing Market Overheats." And I thought of you, being out of New Zealand, that's just a stone throws away. And we've been discussing various statistics regarding global market problems. And you actually did a whole analysis on why global growth is in question. That was the title. So let's just get your thoughts on this.
Yeah, sure. And by the way, as for Australia, I mean, I lived in Sydney about 12 months ago, and I can tell you that the Sydney property market there is pretty crazy. And then there've been some pretty hot housing market there, and to get into that market, you need a lot of debt. So I can understand the stress aspect there, and I guess that's one driver of why I kind of left that place. But yeah, onto the global economic picture. I mean, one thing that I've been really watching over the last 12 months, and even before that, was the developed markets composite manufacturing PMI. So that's an indication of industrial confidence. The big manufacturers across the major developed economies, and so that's Europe, America, Japan, and over the last, I guess, even since 2014, we saw that trending down, and that really climaxed with the market turmoil, sort of early 2016, and then the later part of 2016, we saw that big turn up in that, and that drove that spike in bond yields. Anyone who tells you that that's a Trump thing, that's an election thing, they're kind of missing the point. What actually happened was a big upturn in global growth, and now that's sort of coming into question, or at least to my mind. I mean, we're seeing the developed markets composite manufacturing PMI start to top out and sort of enter into this consolidation period, and the same thing for US 10-year government bond yields. You've probably seen that. They're actually probing the lows just as we speak, and that's those two really do reflect each other. They tend to move in unison. So that certainly does bring it into question, at least.
One of the things that I like to point out quite a bit is just the way people's perception of the markets really impact things. And you mentioned Trump not being the driving force behind that, but certainly he created a very strong perception, and people believed in the economy, whether or not it was false or whatever. He had a salesman's approach that had convinced a lot of people that, hey, things are going to turn around. And he has a lot of people believing that. Any thoughts to that before we move on here?
Yeah, I mean, you can definitely see that in some of the numbers. I mean, you know, I definitely like the anecdotes and, you know, sort of talking about the qualitative stuff. But, yeah, for me, from my approach, I always like to come back to the data, you know, the charts. And,
of course,
you know, you can definitely see that that kind of phenomenon playing out in the, especially in the consumer confidence metrics. And, you know, I saw one chart that was the difference, you know, the consumer confidence ratings for Democrats versus Republicans, and you know, there's this big yawning gap there. So the Republicans were, you know, anyone who's sort of leaning Republican were definitely on board with that, and you know, I think there definitely was an aspect of that. But you know, in terms of the way bond yields moved, you know, I think that really it was the fundamental economic forces that were driving that. You know, maybe it was a catalyst, and you know, in hindsight, you know, you could probably say that.
Callum, just going back, one of the things we started off this interview with was you said the Sydney housing market, and just as a side note, are you seeing a lot of Chinese buyers driving up the market in those areas? We're seeing that like crazy here in the States, specifically on the West Coast, San Francisco, Los Angeles, and, you know, Seattle, and even Vancouver is just known to be going into this massive bubble because of all the buying that's coming in from China.
Yeah, that's definitely contributed a lot to the Sydney house prices. Even here in New Zealand, you're seeing quite a bit of demand from Chinese buyers, and you know, I guess that's quite to be expected. I mean, we saw a similar thing, you know, when Japan was you know, going through its economic development. They sort of went for this offshore buying splurge as well, buying up golf courses all over the world, and you know, it's definitely been a contributing factor to the sort of frothy kind of prices in Sydney, in Australia, I guess in a few other cities in Australia as well. But you know, it reflects a few different things. I mean, very low interest rates, that improves affordability, and you know, just encourages people to go and load up on the debt to get into it. And you know, there's also the supply aspect, because you know, building activity has been pretty good, pretty buoyant, especially in apartments. But you know, it's just not keeping pace with the demand there, because I guess that's one thing that's different about Australia versus some of the other developed economies, is that it's actually experiencing pretty good, pretty consistent population growth.
Yeah, interesting. I didn't know that about Australia. Bill Gross came out and said market risk is highest since before the 2008 crisis. And it really seems like the Fed has been unable to easily hike rates as fast as they've been hoping for. Analysts are calling what we have here a bubble across many asset classes, three in particular: stocks, real estate, and bonds this time around, unlike 2008, which was real estate and stocks, and in 2007, which was just largely stocks. So any thoughts on this as to where we are right now, you know, this many years after the 2008 crisis?
Yeah, well, it's a good point that, you know, I think the same as him in terms of how you look at volatility. You know, risk is high when volatility is low, and you know, risk is often actually low when volatility is high. So you know, it's definitely a tricky part of the cycle. I mean, I look across the major asset classes. I look across. I actually find it hard to gain conviction at this point, and you know, that really just reflects where we are in the cycle. I mean, yeah, we're seeing pretty stretched valuations, definitely in commercial property in America, and definitely in the stock market, depending on what metrics you look at. And actually, for that matter, across the globe, it's quite easy to find relative value in the equity markets. Like for example, Europe, emerging markets, they're still looking pretty good on a relative value basis versus America, but in absolute terms, they're actually starting to get towards the top end of the range that they usually trade at. So, it's a tough point of the cycle, and, it's easy to point to high valuations and say, that's a reason to get out. But, when it comes to timing market cycles like that, you can either take the preemptive approach and say valuations are too high, I'm getting out, and just stay on the sidelines and wait for the thing to roll over, or you can take the reactive approach and say, I'm going to wait until the market starts breaking down, until the the economic indicators start rolling over, and neither approach is perfect. If you take the reactionary approach, if it was a 1987 type of correction, you would have missed out. You would have been too late. So I think it's important to factor in that valuations are very high. That a lot of indicators, especially that I'm watching, are looking frothy. I mean, US commercial real estate, that's something that I've talked about previously, and it's looking the same as it looked prior to the crisis. So, but the missing piece of the puzzle is for the fundamentals to start rolling over. And I think, when you start to see that happen, that's when you want to, get aggressive in terms of being a bit more defensive.
Well, Callum, let's talk about areas in which you might see value at this time. I'd like to throw it out there. Gold has been somewhat breaking out in a stealth sort of pattern here, kind of below the radar. It hasn't it's been in a trading range essentially. I mean, we've been at these numbers now for quite a long time, but it's moving up, and it's been one of the strongest performing assets for 2017. I mean, if you don't count Bitcoin, it's doing pretty good here. So, anyways, what are your thoughts in terms of where the value is right now? And I'd love for you to comment on gold.
Yeah, sure. I'm actually just about to do some work on gold later today, so my opinion might change as the day progresses and I look through the indicators. But the last time I looked at it, I mean, really one of the key charts for me is the gold price versus the shadow Fed funds rate. I'll put the chart up on Twitter once we're finished here, just so that you've got it as a reference. But there's a pretty decent relationship between the two. The shadow Fed funds rate is a indicator that was designed by a research economist actually at the Reserve Bank of New Zealand, leading the research charge over here. And what that indicator does is show you the effective level of where the Fed funds rate is in terms of its stimulus effects when you bring in the effect of quantitative easing. And that if you looked at that indicator, that has provided a pretty good direction for where the gold price is generally trading. I mean, it's not going to trade one for one, but it's still pointing to headwinds for gold. I would say I'm still reasonably bearish medium term on gold. I think that there's going to be short-term trading opportunities as it goes through the range. But as long as the Fed follows through, or is able to follow through on interest rate hikes and winding back, or starting to work through its balance sheet, if you want to call it quantitative tightening, that's only going to increase the headwinds for gold. So I would say overall my view on gold is sort of to have a medium-term bearish bias as long as the Fed's on its hiking and tightening cycle. By the same token, I mean, that just kind of confirms that when things do roll over, the Fed's probably going to go back and do more quantitative easing the next recession, and that's just going to that'll create tailwind. So I guess in that respect, gold retains its value as a diversifier or a defensive asset because the next time we get a recession, the Fed's going to be pumping the money back in, and that's going to help gold.
Sure. What's interesting though is over the past 5 years, this 5-year-long bear market that we've had, we've been seeing that quantitative easing, and it's actually had a reversed conventional effect on gold. We had this downward cycle in gold while the Fed was printing all this money. And if we look now, rate hike to rate hike, when the Fed first raised interest rates, gold has actually been going up. And I totally agree that, quantitative easing and money printing, loose monetary policies should be bullish for gold. And, a tightening of the monetary system, monetary policy should be bad for gold. But it's almost like things don't operate in a sensical way anymore. Any thoughts on that?
Yeah, I mean, it's not going to be moving on a one-for-one relationship, but I guess, if I look at the, I'm kind of cheating because I've got the chart in front of me, but, if you look at that indicator that I mentioned, it had the shadow Fed funds rate at its most stimulatory effect at around 2012, 2013. And that was, since then it's gone from, a level that's sort of indicating around -5 or -6% to, only to 0% as you saw the Fed start to hike rates. So, I mean, on that front, there was pretty substantial headwinds. I mean, if you think about the impact of that, going from, -5% to 0%, it's quite a substantial move. So, I mean, you can sort of see how that could be a headwind to gold. But then, I guess it's sort of in line with what the US dollar has been doing more broadly lately, which is, just entering into that sort of consolidation zone. One view of gold is that it's just an exchange rate with the US dollar, and the US dollar is sort of it's been sort of put into a cage lately.
All right, Callum. Well, hey, I want to thank you for coming on the show with me today. If people want to learn more about what you're doing and the research you're putting out and the services you offer, please give them a little bit of information on how they can reach out and learn more.
Yep, sure. So just head along to the website. So it's topdowncharts.com. I think you can probably just Google top-down charts and it should come up. So on the website, we've got, I do a few blog posts a week, and there's also some material on the social media there, so the LinkedIn company page and Twitter. But in terms of the premium service, so just when you go to the website, if you click on to subscribe, and if you want to check that out, just go ahead and request a free trial, no obligation free trial, and take a look and see if that resonates with your thinking, and we can talk from there. Actually, on that note, I have actually made the 20th edition of the year available as a free download. So if you log onto the homepage of Top Down Charts, you'll see that there. So definitely check that out.
All right, Callum Thomas, everyone. Callum, thanks for coming on the show with me today. I really appreciate it.
Thanks, Ken. There's some good questions. Enjoyed the conversation.